prices grow, and also there's a limited supply of land, particularly in capital cities. People are looking to utilise their properties as much as they possibly can in terms of usage of land space. This, however, has created quite a few issues that most taxpayers are unaware of. So this presentation today actually comes from an article I wrote for the Your Property Investment magazine, which actually discussed some of the issues in terms of taxing granny flats. Now, can I say from the outset, these slides are not exhaustive in terms of the particular issues you're going to face with granny flats. When we talk of the concept of actually a granny flat, it might bring up a lot of different ideas in your mind. So we're going to go through some of the issues, certainly, but we won't be covering all issues. So certainly for our clients, if they're looking to do anything with anything that resembles a granny flat, the best thing to do is actually talk to your relevant contact at WSC Group, and we can advise you on a specific advice. Okay, just a couple of things for those that may be with us for the first time. Who WSC Group? We are obviously a trusted advisor, and we do have a special focus on property investment, tax, business advice, and self-managed super funds. And that's what we're trying to do with our clients, help them achieve their long-term goals. And you can see that we have over 3,000 investors amongst our 4 offices and 2 serviced offices throughout Australia. We also do a lot of modelling for clients and looking at after-tax and before-tax costs of property. So lots of things we do. I have an interest in 30 properties myself, so what started off as a passion has now become a substantial business, because we've realised that a lot of the accountants in our profession don't understand this space that well. So this is one of the issues. We certainly see that there's some mistakes being made by our taxpayers. So look, what we're going to discuss today simply is firstly the concept, what is a granny flat, and I'll talk about that very shortly. And also many property investors are now investing in large blocks of land, specifically with a view of putting a granny flat on the property. And also granny flats are very popular for investment properties, and also popular for families and principal place of residence. Now, just think in your mind, there's a couple of things that might come to mind which I've just covered in terms of what a taxpayer might want to do with a granny flat. There's obviously the group of investors who've actually bought an investment property on a large block, and now they're looking to more utilise, get a better yield out of that block by putting the granny flat on the back. So that's sort of one group of investors, right? And that group of investors you could even segregate into probably 2 subcategories: those that are buying and putting a granny flat on, holding long term, and those who are really developing, pseudo developers, and maybe wanting to sell the granny flat short term. Obviously granny flats are also particularly popular with families, and there's various types of granny flats. For example, many people will want to have an elderly, parent live with them. Some granny flats will be more like an attachment within the principal place of residence, where it's really part of the principal place of residence. Other granny flats will be very much standalone, and we start to get issues, particularly where you're charging rent even to family members. So you can see there, even with those couple of images I've described, you're going to have a lot of variations on what can be done with a granny flat. So look, the main tax issues, and I'm just going to discuss 4 main tax issues today, and the first of those is granny flats and principal place of residences. I've just summarised that, PPRs, that's what we're talking about. Then we're going to talk about granny flats and GST, and I'm focusing more on a short-term development as opposed to something that's hold for a long period of time. and then we're going to touch base on income tax issues and capital gains tax issues. So these are the main issues that you really can come across. Now let's have a look at granny flats and principal place of residence. So there's a number of variations, but I'm just focusing on one particular type of variation. It was an example. The figures aren't the same as what this client did, but this client in particular had a principal place of residence, and they were looking to build a granny flat on the back of this property with the view of actually subdividing and selling the property. So it was a rather, perhaps a little unusual, but it was something that the taxpayer was looking at, and with the subdivision it was going to be a very long-term 5-year to 10-year sort of thing, so 10-year goal. So it was never for a short-term gain. But in this example, I just wanted to point out, you could see there, originally they bought that property for $400,000, and I've actually split that up in terms of evaluation between the original house and the land value, and then the subdivided land value. Now let me just quickly go through that. The purchase was $400,000, right? In this case, the client was keeping their original principal place of residence, right? And they had a long-term goal of building a granny flat. You can see there $100,000, but they were going to eventually subdivide that land. So in this case, we have to, where we've got subdivided land, actually you have to apportion a cost to that original land. And at the time that this was undertaken, the property had that value of about $400,000, and we apportioned about $100,000 in land value. Right, constructed the granny flat, and so the cost base for that property, and this would apply more not only to granny flats, but where you'd subdivided land and build a normal house on the back of a property. But you can see there with the apportionment of the land of $100,000, you end up with a cost base of about $200,000. Subsequently, in about 5 years' time, that client wanted to rationalise some debt. They'd originally always wanted to hold the property, rationalise the debt, and eventually sold that property 5 years later after the subdivision and after renting that property for 5 years for $300,000. They never had the intention of having a profit-making scheme. It was just an investment property on the back of their house. In that case, they sold the property for $300,000. They had a $100,000 gain, right, of which they were entitled to a 50% capital gains tax discount and had a taxable capital gain. So this is what taxpayers mistakenly believe sometimes, that on their own principal place of residence they could actually subdivide off a block, build a property, albeit a smaller property, a granny flat, etc., sell it off, and that sale would be covered by the principal place of residence exemption. As soon as you subdivide that land, you create a separate taxable asset. It's called land, and basically you have to then apportion a cost base based on, you can see there, the $400,000, which was what the property was worth at the time. So in fact, you do need to go back and look at your original costs there. Sorry, not just the value at the time, but the original cost of the $400,000, and that's what the property originally cost that taxpayer to actually purchase. All right, now our next slide talks about granny flats and GST. This was an interesting example, as that we had a client who actually bought an investment property, a big block of land, thought it was a great idea to build a granny flat, subdivide that property off, did it really quickly, and then we had to tell them the bad news about their GST and the actual taxable problems they had. Now, a couple of things on this slide. The construction of a granny flat constitutes a new residential premises for GST, and therefore if you sell that property, and there's various rules in relation to when a property is not new or is new, there's a 5-year continuously rented period, but that can also be circumvented if it was seen to be an isolated profit-making scheme. You're going to have a GST issue if you do this and then sell the property. More than that, if you always went into a profit-making scheme, you're going to have tax at marginal rates, right? And you can claim a credit for the GST on the construction of the granny flat. And you are able to sell the property under the margin scheme, and I'll explain to you what that means. So this is a real-life example with the figures being changed, and with your granny flat and GST, and this doesn't bear any it's a different scenario than we looked at just previously with the principal place of residence. Just the fact that the figures are similar is merely coincidental. But for example, I'm trying to keep the example very simple. You can see there, if you had land of $100,000, so that was the apportionment of the back block, right? So the client had an investment property, just the land portion on the black block was $100,000. They then built the property for $100,000 plus GST. They're entitled to claim back the $10,000, right? So they had a cost base of $200,000, got a claim of $10,000 back. But when they sold that property, because they bought and sold that property, you can see was within a short time frame. It wasn't a principal place of residence. The sale was $300,000. The GST on the margin, and this is the margin scheme and how it works, was $300,000 less the land. The apportionment of the land, which on that back block was $100,000. We had GST on the margin, which was $18,000. So we actually claimed $10,000 on the construction, but had to actually pay $18,000 GST. After the GST, the net sale price was $282,000. For these purposes, I've just excluded agents' fees just to keep the example nice and simple. So the net proceeds after the GST were $282,000, and the profit was therefore $82,000. And guess what the bad news is? You've got to pay tax on the entire $82,000 profit. So although I said it's different figures, a client of ours went ahead, actually did this and didn't tell us, and then we had to give them the bad news after the fact. So something to keep in mind, there is no way that you can get around these GST issues. Some taxpayers in the past have actually thought that if they just didn't disclose this and just sold it, there wouldn't be an issue. Well, the Office of State Revenue are working with the tax office in some states to go back over property sales over the last 10 years. So I wouldn't advise just doing this and not disclosing the taxable implications. Okay, so our next slide talks about, there's a couple of rulings, and when we talked about the isolated transactions, you can see there on the next slide we're just about to go to, tax ruling 92-3 and 4, these are rulings that actually, not specifically relating to granny flats, but they deal with isolated one-off transactions. Sometimes taxpayers mistakenly believe that if they just do something one-off, they hold the property for 13 months, they'll be entitled to the capital gains tax discount. That's not true. It's actually your intention with the development, and that could actually go back and actually be queried by the tax office by looking at bank records. So these tax rulings are worthwhile for a read, and they address one-off property, one-off developments, and actually the rulings state that income tax will be paid at the marginal tax rate. So when we look at marginal tax rates, then you might want to be looking at structures whether you have some of these entities in trusts, companies, etc. So that's probably not outside the scope of what we're going to talk about today. But you should, if you're looking at doing a one-off development, have a look at those two tax rulings because they do actually set out the cases where you're going to pay income tax at the top marginal rate. There was a recent court decision where a developer tried to claim a capital gains tax discount where they'd hold a property for more than 10 years, and the tax office won the case. So be very, very careful about even the 5 years. It's all about your intention and what you're trying to do. Okay, so look on our next slide, and we just talk about the granny flats and capital gains. Really, to receive the capital gains tax discount on a granny flat, these are just some general principles that you may want to be thinking about. So we're looking at an investment property. It's always got to be your intention to build and hold the dwelling long term, right? We talked about the GST, new residential property not being new anymore when it was rented out continuously for 5 years. And certainly 5 years and above would be a period of time. It would be harder for the tax office to argue that you were just doing an isolated short-term profit-making game, right? And your intention when you want to claim the capital gains tax discount would always be to do that from day one, okay? And another thing, and really important, you've got to be able to prove that in the event of a tax audit that you don't run a business which does multi-granny flat developments. Really dangerous if you're doing it a number of times, because what does the tax office have? They have the benefit of hindsight, and also land titles officers have the benefit of hindsight to see what you've been doing and buying and selling properties over a number of years. Okay, so where to start? We're up to our last slide now, and where to start is really the important thing. Firstly, when you're looking at doing any of these things, be it with granny flats in particular, because we know the New South Wales government and in Western Australia as well, providing you pass their criteria, which I understand is 350 requirements you've got to meet in New South Wales. I don't know how many there are in Western Australia, but you will actually be able to build a granny flat on the back of your property. But providing you get past those complex issues in terms of being able to plan and build a granny flat, the big questions are, of course, let's get the right advice. What are we trying to do? Are we doing this in short-term profit making, or are we doing this in long-term and we're really looking at to be an extension of our investment property portfolio? Of course, the other issue which we've discussed is, are there tax consequences, which of course there are when we actually want to put a granny flat on the back of our house. And we haven't even discussed some of the issues that would relate to if you're renting properties out. But we wanted to start with this webinar because there's quite a lot of this activity going on. So my view is get the right advice up front, work out if there's tax consequences and there's GST consequences, and then work out if it's actually worthwhile doing. We just had a client that did this granny flat development and unfortunately worked out at the end of the project there was no profit. Maybe it would have been a good thing to actually work that out at the start and then be in a position where you could make an informed decision rather than a decision that, well, knowing a decision that you didn't make money when you thought you originally would. So look, I think that's probably all I've got to say on the webinar. Sarah, are we having any questions? Opening up for questions?
No questions have popped through. If you do have any questions, feel free to pop them into the question box there on your screen, and so David can spend 5 minutes now and he can answer those now. If you do think of any questions after this webinar, feel free to send them through to either David directly at david.shaw, SHAW, @wscgroup.com.au, or through to the info line, which you will get after the follow-up email after this webinar. You'll get one through.